All right. Good afternoon, everyone, and welcome to the Battle of Stablecoins. I've been actually looking forward for this panel for weeks. I'm very honored to share this stage with these two fine gentlemen. As Anna said, to my right, I have Joao Reginato, representing USDC. And also to my right, but further away, we have Rune Christensen, who's going to be representing DAI. So before we dive into the technicalities, let's set the scene first, right? The entire M1 conference revolves around the concept of a blockchain-based financial infrastructure, an alternative to the current infrastructure. And we started yesterday with our protocol, the Melon protocol, which puts the fund management process on-chain and is integrated to decentralized exchanges. And we heard Ethinex and DutchX and Kyber. And then we heard from people bringing liquidity in there. And just before the session now, we heard about different more exotic on-chain products. But if we take a step back, one of the most fundamental and most important parts of the ecosystems is just basically a very simple, stable medium of exchange that people can use to transact with each other. So now I'm going to give you guys each about a minute to explain to our audience how your stablecoin works. The rest of the panel pretty much relies on understanding this part. So if anyone is not clear after the explanation, please ask now. So Joao, why don't you start?
Sure. Thank you so much for having me. I love Switzerland, and I've never been to Zug before, so it's good to come here and get to know this ecosystem that people talk all over the world about. So I've been with Circle for many years, best part of 4 years now. And have been working in our USDC project, which is actually something. So USDC, to begin with, is a fully fiat collateralized stablecoin. It's a very, very simple design principle, right? I think a lot simpler than something like DAI. It's a lot more pragmatic, perhaps. We have been working on that for the best part of a year now, and what we have done is that we have spun off of Circle this consortium called Center, which later last year Coinbase also became part of. So it's basically a consortium of companies where the consortium defines the technology stack for something like a fiat token like USDC. It defines the government policies, and then it introduces the ability for companies to join this consortium as issuers, and so Circle and Coinbase are issuers. And these companies typically are companies who are regulated to perform the bridge between the traditional fiat world and blockchain technology. And obviously, as you guys probably know, Circle and Coinbase in particular have been doing that for many years now. So they basically provide services for the community so that you have this on and off bridge from fiat to the crypto version of the token. And then once fiat is tokenized, it's an ERC20 token, and anybody can use in any compatible exchange or wallet or service. USDC has been doing fairly well from our perspective. We launched pretty much at the end of September, so it's been going for about 4 months. It has around $300 million in terms of market cap. It has over $5.5 billion have been transferred on chain to date. Maybe 1.7 billion has been traded on exchanges. It's available on over 8,000 wallets. So it's been adopted to a level that for something that has been launched in 4 months, we are extremely happy about.
Cool. Rune?
Yeah. So also thanks everyone for coming, and glad to be in Switzerland. Always enjoy coming back to Zug, checking out the Crypto Valley. So so let me try to give a 1-minute introduction to Maker and DAI. Right. So what DAI is all about is combining sort of the fundamental characteristics that make blockchain really exciting, right? Which is decentralization, transparency, and sort of the resilience and sovereignty, I guess you can say, of blockchain technology, with what's really important out of traditional finance, which is stability and certainty and risk management, and basically combine it into one system that then allows us to actually create cool stuff with blockchain for the long term, right? And yeah, the way it works is a little bit like the gold standard, as you can say, right? It's like the reason why DAI has stability and the reason why DAI has value is because it's backed by real assets and liquid assets that has, verifiable value in the market that then sits locked in smart contracts on the blockchain. And this is all completely cryptoeconomically sort of locked down so that you know that there's always going to be more value of collateral in the system, that there are outstanding DAI in circulation, and there's no like backdoor access or some authority that sort of has special control of the system. Rather, it is a completely decentralized community, basically, that governs the risk of the system, but again, without kind of special access to it, really, beyond governing the risk parameters of it. And then the goal is basically that the incentives of this governance community that governs and regulates the system ensures that they will choose and accept the right types of collateral into the system to back DAI with, and enable people to enable DAI to be backed sort of on the right terms, depending on what the risk of the collateral is. So what's really interesting about this model is also, in addition to being fully decentralized and all of that, and creating a fully decentralized stablecoin, it also actually creates a fully decentralized credit market. And DAI has now been live, so actually the beta version. So we right now are still only running the beta, which has been live since December 2017, so a bit more than a year. And it's been very popular, both as this kind of DApp-focused stablecoin for decentralized applications, but especially also in particular the credit application of it, right? So we've seen, so right now there's actually more than 2% of the entire Ethereum supply is locked up in this decentralized smart contract and used as collateral backing DAI. And I remember just recently I saw in some stats, just to also give some stats that make us look good.
I have the dashboard here for you, Rune. It's a snapshot there.
Yeah, this is MPR. Yeah, so you can, and that's what's cool, right? You can see all of this stuff directly from the blockchain, right? But I just recently saw this statistic that that Maker was actually able to provide the amount of loans in its 1 year of operation that it took Lending Club 5 years to get to, right? So Lending Club is this really big peer-to-peer lending platform. And yeah, I mean, and there's a lot more to it than this, but basically, it's kind of there's a credit platform, and then the stability side together enables this decentralized stablecoin, which, yeah, I mean, I guess we can get into the...
Don't worry, we have like 45 minutes.
Yeah.
We're going to get into it. I'm going to construct a little scenario here for us. Yeah, we have Yaron here in the front. We imagine Yaron is a Melon fund manager, right? He can only trade on chain, so he doesn't have the opportunity to, he can't get access or exposure to real assets or real currencies that are not on the blockchain. And because the crypto market recently has been very volatile, he wants to reduce his exposure, and he wants to buy some tokenized USD to do that. So as a responsible asset manager, Yaron will probably be concerned with those three main points. So number one is, as you already mentioned before, stability, right? Is my tokenized dollar going to be worth exactly $1 in the future as well? Number two is how risky it is for me to hold the stable coin. Yeah, and that's going to be interesting. And number three is the regulatory status. So let's start with the first point, stability. Rune, over here, we're going to start with you. I have the 1 year price fluctuation of DAI. And for those people of you in the background, it's not as volatile as it looks here. I just don't know how to adjust the y-axis on CoinMarketCap. The DAI is pretty much pegged to the USD at $1 constantly, deviating by 1 or 2 cents. You mentioned incentives, right? The economic incentives. What economic incentives are in place to guarantee that the price of DAI will stay close to the $1 mark?
So that's a very also very deep topic. So I'll just give try to give a very basic idea of it, right? So so really what it fundamentally comes down to is what's called a Schelling point, right? So it's kind of like the point is to construct this shared idea that valuing DAI at $1 is sort of the optimal and the standard sort of behavior for everyone in the market. And that way market participants coordinate to actually value it at exactly $1. And in terms of the strongest level of enforceability for that, like how it's really truly enforced to guarantee that this is the rational thing to do for the long run, is actually through a mechanism called emergency shutdown. So that's literally shutting down the entire system and then settling everyone at the exact net value they're entitled to, sort of in the, like, as the sort of the theoretical worst case scenario as a holder of DAI, right? So, and that's where it comes back to kind of the gold standard analogy and how the important thing is that you know there are real liquid assets backing it, right? Because what that means is that as a DAI holder, the worst thing that can happen to you is you'll get, instead of having one DAI that's worth $1, you'll instead have like basically a basket of, or like an index of various different assets that all, like, they're very diversified, coming from many different asset classes, and together they have a value that's worth exactly one DAI. Oh, sorry, exactly $1 for each DAI you hold, right? And because you have this fundamental long-term guarantee built into the system, that you create sort of the beginning of the Schelling point, because you know, okay, in the worst case scenario, that's what can happen to me, right? Then on top of that, there's a more short-term dynamic that helps ensure that, that sort of builds on top of this long-term guarantee, but then helps drive really short-term liquidity and stabilization. And that is what we call, well, I mean, okay, I guess a more fun, like an easier way to explain it, it's just interest rate adjustments, right? We actually call it savings rate adjustments because we call that, like, sort of that functionality in the system, the savings rate. But really it is about changing the interest rates of the system. And this is analogous to how central banks, they stabilize their currency, right? So just like how the Fed, when they want to change the exchange rate of the dollar, actually the Fed is a bank example because it's free floating, but if they wanted to change the exchange rate of the dollar relative to some other currency, they would, for instance, if they think that the dollar needs to increase in value and get stronger purchasing power, they would increase the interest rates across the American economy. Because this way you'd have more people investing into the American economy and sort of inflows of capital, which would just create more demand for the dollar and ultimately drive the price up. And you can do the other thing also, right? You can cut interest rates, which in return creates outflows of capital and kind of, like an expansion, right? That basically drives down the exchange rate. And the way DAI is then stabilized for the short term is really just through constant adjustments like this. Right now, they're actually not that, like, they don't happen that often, actually, and we actually just initiated another adjustment literally yesterday through the governance process. So this is the decentralized community coming together to control the system in this way. And eventually, over the next 2019, so the foreseeable future, the plan is to actually do adjustments like this every week. And then, so now we're down to sort of a week's granularity. And basically from that point then it comes down to finally the Schelling point and the arbitrage, where people, like individual traders in the ecosystem, effectively what they do is they bet on the ability of this process to continuously bring the price back to $1. So at any point in time where they see, let's say, the price of DAI is at 99 cents, or it's at 1 point, like it's 1 cent above $1 or something, if they trust the long-term guarantee of the emergency shutdown and settlement, and also the viability of the short-term process, then they have a profit motive to go in and, like, buy cheap DAI because they know it's going to go back to $1. Or even if they have some collateral, generate DAI if they see the price is above $1, so they can sell it while it's expensive and then buy back and pay down their loan later when it's cheap again. So that's the shortest version of how it's stabilized, I guess.
Joao, is USDC's stabilization process equally complicated as we just heard from Rune?
No, I think this is where it gets interesting, right? Because the approaches are very different, and it doesn't mean that one or the other is wrong. So USDC works in as people I think appreciate it works in a very different way. It's a fully fiat collateralized stablecoin. So what that means is if you want to read a little bit about how that mechanism works, you should probably read about currency pegs. That's the best analogy, right? So there's something called a buy wall in these currency peg mechanisms. I mean, many countries, have tried this in the past and continue to try. Usually they have a limitation in maintaining their currency pegs against some other currency, which is the size of their buy wall, right? Because If you want to be, fully collateralized, you would have to have this gigantic buy wall, and most people don't have it, and that's why currency pegs, in traditional FX can be broken.
Real quick, you say buy wall. Do you need an equally big sized sell wall as well, or is buy wall the most important factor?
Yes. By definition, it's the same.
Right.
But the most important element of it is the buy wall. So meaning that whatever the other side of the currency, which is the tokenized version of it, right? So the amount in circulation of USDC, we have got to have enough of a buy wall to guarantee the price. And the best way to guarantee the price is to make sure that, by the way, you have 100% of a buy wall. So if we have right now, I don't know, last time I checked, that let's say 280 million tokens in circulation, we have to guarantee that we have $280 million at least in custody. To, if anything happens in the market, something like that catastrophic scenario, and everybody wants to cash back out, that you can provide that liquidity to the market, and basically everybody gets one for one. Now it gets to the complicated part, right? So
before we continue to the next part,
sure.
sorry, Joe, to interrupt. We don't actually have to trust Joao on that, because I have the last audit report of USDC right here.
And I was going to get onto that.
Oh, please then talk about it. I just gave you the slide.
Right, because in theory, it's interesting, right? So you can say, yeah, let's have 100% buy wall, and let's work. And then we're all humans, and you try optimizing these systems, and we have seen, I think, perhaps that in the past, and maybe people want to operate with an 80% buy wall because, they can be smart, and we all want to make money. If you have something like that, an approach like that in such a solution, eventually you're going to get burned, and you're going to get burned pretty badly. So you have to your point, you have to trust, which is something that we talk about a lot in our industry, right? And don't trust, verify. But how do you move then? It's like peeling an onion, right? So how do you move from understanding that you have to have a 100% buy wall to effectively having it, right? So we can say that we have it, and we can ask people to trust us. That's not going to be good enough. So the mechanism that we have devised in this space that work with us, as a regulated entity, it works for Coinbase in similar principle, and is going to work for a number of other companies who eventually join Center as issuers if they are regulated in their own jurisdictions in similar ways, is that you work with an auditing company that comes in at regular intervals and look at basically, and this is really not very sophisticated, even though some people claim that it's a difficult thing to do. Basically, it involves granting them the right to talk to your banking partners, and picking up the phone and saying, can you tell me, and can you prove how many dollars you have right now at this particular point in time on this particular bank account? And obviously, banking partners under certain conditions will help you prove that. But then, that's still probably not good enough, because you're basically, peeling the onion, but involving other layers of trust, right? And who are these companies, and who are these banks? So we attempt to work with the best partners when it comes to that. So Grant Thornton LLC is, for people who know the industry, is a pretty well-known auditing company, probably a top 5, top 6 in the world, depending on the particular segment. And then also what we wanted to do with the model to make sure that we can continue to peel the onion and have less and less central points of failure is we introduced this idea of, this is not a circle coin, as some others are. This is a consortium of companies, right? So you have this company, this entity that introduces governance, but it doesn't actually touch customers' funds. And you have the other companies who touch customer funds, but they are not centralized. They are not central points of failure in the system. And we have right now Circle and Coinbase, but we have as a roadmap to introduce, and you should expect to see more and more issuers coming on board, with the same level of capability, and therefore reducing the level of counterparty risk, just because you're distributing that across a number of companies. But similarly, in terms of how the reserves are backed, so we distribute our reserves across multiple banks, and we want to start working with more and more of these auditing companies as well. So it's a very different approach, but it's very simple in terms of how it is designed. You could probably explain it in a one-pager. It has pros and cons compared, obviously, to DAI. But yeah, that's how it works.
Yeah, I'm looking forward for that. For seeing other companies issuing their USDC. Let's move on.
Yeah, it's coming up.
Do you have already some partners in mind, or like?
No, we usually don't talk about what's coming, but I can tell you it's something that we have been working on. As soon as we launched the consortium, I think we were very effective in attracting Coinbase. I think it was the #1 company that we had on our list. If we wanted to partner with a company, who would be that company that would bring the level of trust to the industry, and Coinbase is very aligned with us in terms of vision and how they see this evolving and how they see this being beneficial for the industry and for our collective products and services and products and services that other people are building on top of crypto. And I think we're going to talk about that in terms of use cases later. But you have a lot more of those companies around the world, and we are excited to see companies joining from other regions as well.
Okay, let's move on to the next one. So we talked about stability a little bit. Let's talk about risk. Rune, do you actually own any USDC?
You mean if, like, in my personal wallet?
Yeah.
No, I don't.
Okay, but I mean, we are outside, and we talked. You said that it's not just possible, but like likely or in the pipeline, that you could imagine that other stablecoins could be used for multi-collateral CDPs. So I want to ask you, could you see USDC as being one of the assets used as collateral, and what are the main risks that you see if you would take USDC?
Yeah, so the goal of DAI really, and the goal of making a decentralized credit market, and the way we see that it's realistic to actually scale a decentralized stablecoin is through massive diversification of the collateral, right? So it's all about having as many different types of collateral as possible and having them be as different as possible from each other, so that their difference in risk and pros and cons all outweigh each other. So from that perspective, there's already an argument for adding actually pretty much anything, right? Like any token would always, if it's different enough from what's already there, add some level of diversification and then help hedge the risk of other assets. So from that perspective, there's an argument for kind of like using other stablecoins as almost like a counterbalance to other types of risks that exist in the system. The only problem, I guess, is that you ultimately always have to pay for credit, at least. Well, I mean, you actually, and this is actually another thing. So you can actually also support negative interest rates, and you can't even have a situation where it's like profitable to lock up an asset that doesn't appreciate in value just because there's actually negative interest rates in an economy, right? But a more fundamental use case that we see is really critical in the short run, where we want to see centralized stablecoins like USDC used, is just to help provide liquidity and stabilize DAI in the short run, because the big advantage of DAI is that it's really nice to hold in the very long term, because it's decentralized and it's like it's your sovereign on-chain asset and so on, right? But the downside it has is that it doesn't really have that sort of native attachment to the financial system, right? So it's not very easy to go from traditional finance straight into sort of the deep blockchain space. And that's where centralized stablecoins are really awesome as kind of like this, like they really sort of straddle that edge, right? They're sort of half traditional finance, half crypto blockchain. And that also means that they're really perfect for kind of like trading against DAI, for instance. And actually right now, DAI, you can trade DAI against USDC in many different, like both decentralized exchanges, but also on Coinbase, for instance. And we see that as a really important step in creating that more, like that stronger attachment between the banking systems and traditional finance and the money in your bank account, and then with the DAI and the blockchain. And then to the collateral part, right? So where it gets really exciting is that by using something like USDC, which is already like an asset that's traded against DAI for liquidity, as collateral, we can really supercharge this level of liquidity that we have access to. Because while regular people may not be interested in locking up 1 million DAI and then borrowing less than locking up 1 million USDC and then borrowing less than that and pay an interest rate on a loan, that, like, I mean, a lot of people like, that doesn't really make sense to me, right? And that's true, it doesn't make sense to most people, but those it does make sense to other market makers, right? So if you're providing liquidity, like in DAI against USDC, for instance, you're actually really, really happy to have access to this like large scale, low cost and very swift credit facility that CDPs provide. And so as an example, if you imagine a market maker that has $1 million in capital, right, to provide liquidity with, if he doesn't have access to like a CDP like this, then if someone comes to him with $1 million, like let's say someone comes to him with $1 million USDC and it's like, I want to trade this. Well, yeah, if someone comes to him and he has $1 million in capital, at most they can come with $1 million USDC and trade that for $1 million DAI, right? Because that's his million in capital, and now he's spent it, and now he's sitting with $1 million USDC, so he can't really facilitate any more onboarding. But if he has access to a CDP, that CDP will be able to give him incredibly high leverage because it's a stable coin, right? So the risk parameters can be very, very like sharp, right? I mean, it's very close to just being almost one-to-one in a collateral portfolio. And also the interest rate can be very low as well because just like the overall risk is incredibly low. So you could easily give something like 100x leverage here. Like you could actually have a market maker with just $1 million in capital facilitate a single transaction of $100 million moving into DAI.
Wait, you have to repeat that again. Right now the collateral level of DAI with Ether is 150%, right?
Yeah, that's right.
What is the 100x?
So that would be less than 101% in liquidation ratio.
Oh
so
my.
This is what, I mean, when you look at Forex pairs, right?
Yeah.
And leverage in Forex trading, I mean, then when you're doing, Forex, so you're actually talking about different currencies. You typically do 100x leverage. That's a pretty common. So that's basically a loan to like that's in maker terms that's 101% collateralization, right? But this scenario you're talking about here is actually dollars to dollars, right? So it's actually it in theory it would be safe to go even further than that. And yeah, so that's what enables like very conservatively enables 100x leverage for market makers, and thus just like means that if you're coming with $100 million and you want to move into DAI, or maybe you want to move on to some other stablecoin elsewhere, or move out of you want to do some big remittance transaction or something.
Yeah.
It's just going to be possible to facilitate this at very low spreads as a market maker, because even you don't have to deploy much capital, and you can handle giant volumes. So if you just take a tiny slice in your spread, you're still going to make plenty of profit. And this just creates an incredibly liquid network, right? And really sort of a network effect where all of these things sort of plug into each other and generate more value.
Wow. Yeah, if I can just add to that, I think that's when it becomes really, really interesting. And that's why I think we were talking before, we don't see necessarily, I know we're talking here about the battle of stablecoins, right? But there's really not much of a battle, because when you combine these solutions for the industry, is going to be a tremendous opportunity. And something that I didn't touch before when we talked about price stability, but we are all about liquidity. A fiat-backed stablecoin is all about liquidity, because you can claim you can do all that work that we did, but if it's not extremely easy and liquid for you to go between fiat and USDC and back, and you do read about some issues in the market with other solutions. That will also impact the price, right? So if you gotta make sure that because of the way that a company like Circle and Coinbase are regulated and operate that bridge between fiat and crypto, we have to be really serious about customer identification programs, KYC policies, all those things. But also you can build those services in such a way that they are tremendously easy to use, right? And I think we are companies, and there's a lot of other companies in this space who can do that. Then you have to have very solid banking partnerships and basically very good technology stack that is not necessarily in the crypto space, but it has to do with allowing people to move very, very swiftly and at large scale from fiat to USDC and back. We are tremendously proud. That's an area of expertise that we have. We currently allow people to go, and we have market makers that do that on a daily basis, to move hundreds of millions of dollars a day between bank accounts and USDC and back in a matter of 30, 40 minutes sometimes.
That's fast.
That's pretty good, or as
some folks in my team like to say, it's not bad at all. But like seriously, this is a really key piece of capability that is totally complementary to something like DAI, right? And when you combine those two things and you allow all these market makers and economic actors who want to obviously make a profit from arbitraging all these situations, if you allow them to settle very easily, and if you give them the confidence that they can have, you know, tremendous liquidity between fiat and USDC as a ramp for then engaging in some of these other activities, it becomes a really, really compelling instrument.
No, I 100% agree. I know it's called Battle of the Stablecoins, but based on what you guys say, that sounds very complementary. But I want to dig a little bit deeper in here. I mean, USDC prides itself in being fully regulated. We saw the audit report, it was absolutely perfect. But a side effect of being fully regulated is that you have to be compliant, and which means that I think that the issue of the USDC must be able to stop the moving around of the token if they think there's some criminal activity going on. That's correct, right?
Yes, let me correct a couple of things. This is unfortunately an area for a lot of miscommunication, misunderstanding in the industry, but essentially what you said is correct. So, but let me talk about a little bit more in detail to the extent that I can about the mechanism. So
1 second, Joao. We have 1 minute.
1 minute. Oh, that's gonna be my tough 1 minute now. So first of all, to make sure that people understand the structure again, right? So we have this entity called the Standard Consortium,
yes,
and we have right now Circle and Coinbase as issuers, and hopefully many other issuers in the future. When you look, and this is open source and free for people to use, I invite you to go and have a look at the USDC smart contract. There are basically a couple of different, you know, operations on the contract, and there are a couple of different roles that can perform those operations. One of the operations that you're referring to that people talk about is this operation called blacklisting. So basically you can go and you can blacklist an address, and effectively that blocks that address from moving funds, right? So if there is, you know, funds in that address, it freezes. Otherwise, it just makes it impossible for that address to transfer any funds.
Has it happened until today once that you guys had to do this?
No, we've never used that mechanism to date. No.
All right.
The one thing I wanted to point out though is that because the operations on the smart contract have different roles, and for you guys who understand how this works, effectively you will have different entities responsible for operating that. Circle and Coinbase as issuers do not have that capability. So issuers don't have the capability of blacklisting. That is a capability that is actually associated with Center. And we are in constant conversation with regulators, and you know, it's something we believe in. I think if we want the industry really to mature and to continue to drive towards mass adoption, we have to be concerned with consumer protection. We have to be concerned with illicit activity, with, you know, things like money laundering and terrorist financing. We have to fight those things. We have to be really, really ruthless about them. I don't think the industry, we were just talking about it, right? I don't think it would be good for the industry to have a black eye if all of a sudden we detect that something like that is happening on a stablecoin like USDC or any other. So we absolutely have to be responsible and protect the rails from this kind of activity. That's why we work with regulators, and that's why we have those mechanisms. We are still, you know, defining from a design point of view when that mechanism has to be used, and we hope that, you know, in the near future we can share with the community in a bit more granular detail when that mechanism can be used and should be used. But it is something that, you know, ultimately it is there to be used for good reasons. It's not there for surveillance. It's not there for, you know, for me sitting on my desk at Circle and saying, I don't like this transfer, I'm going to freeze it. That's obviously not the way it's ever going to work. Just
of course, yeah. But anyway, I mean, Rune, earlier when you're talking about, you know, including USDC as a collateral, one underlying asset as collateral for the multi-collateral DAI, you said one of the benefits was diversification, right? If you just have Ether as a collateral, if Ether crashes really fast, a lot, it might trigger the global settlement. If you have 5 different assets in there, if one crashes, it's not that bad. But my question is, what would actually happen if you have USDC in your multi-collateral DAI or CDP and it freezes?
Yeah, so I mean, that's when it comes to I mean, so what Maker is all about is like risk, basically figuring out the risk of this kind of stuff, right? What is the risk to the different types of collateral that exist, right? And then something like Ethereum has that high volatility risk, but it does have the advantage that it actually has inherent cryptoeconomic value. However, for the long run, we really don't see that as being that's not really going to be the bulk of what makes up the value backing DAI. Like ultimately what we're looking at is, well, it's going to be a significant part of it, hopefully, and actually over time, increasingly more so as we see real decentralized projects popping up, right? But what we also really focused on, and I really just generally think is it's just so important for scalability. It's just you need to have real value in there, right? Real world assets, just like regular stuff, like especially when you think about things like real estate or stocks, and like you can only really create a scalable currency and a financial system that is based around these things, right? Because that's what you use money for out in the economy. So that's what the money has to be backed by in the first place, to a large extent. And then, of course, again, it's really great to have a lot of diversification. So when all of these things I'm talking about here, security tokens and just real-world assets, basically have the same issue as USDC, right? That they ultimately are controlled in a legal framework, and they need to comply with laws and regulations, and there's a responsibility to prevent someone who deals with this kind of stuff from supporting illicit activity, and this is just, and that's just how the financial system works, and that's kind of how it's kind of the social contract of how the government makes sure that these assets has value, but in return they also use that assurance and use that sort of that role to also fight crime as they want to fight it. And then of course sometimes they define crime the wrong way and so on, right? And which is a completely different issue that we actually also think in terms of, because that's where we look at what are the nice jurisdictions and what are the not so nice jurisdictions, right? But anyway, so the point is that this risk is really fundamental, not just to centralized stablecoins, but to a lot of the stuff that needs to be included as collateral. And it's all about analyzing and quantifying the risk and ultimately hedging it out, right? So one big and interesting question that we were also just discussing is it's going to be a big difference from jurisdiction to jurisdiction, whether if let's say they want to freeze, we were talking about that specific area, right? Freeze or confiscate a CDP, right? So like a loan position in the Maker system, whether they go in and they sort of confiscate, they sort of just slip out the collateral only through the back door, so they just take the stablecoin only and they leave sort of an empty unbacked CDP, or whether they confiscate the entire CDP, including the debt, basically, which is, it's kind of like funny scenario, and it's going to be interesting to actually look into that through, engaging with regulators and lawyers, I guess, right? Because I think the answer will be different in different jurisdictions. But basically, there's actually a way that a jurisdiction can give assurances that the way they would use these kind of backdoors, because of that, that's also the thing, right? It's not even really the centralized stablecoins that can use these. I'm pretty sure that if you just, like you're talking about, if you just sit on your desk and you just freezes someone's USDC, you'll just get hit by a lawsuit and you'll end up settling, and the money will, you'll pay the money and damages and whatever, right? It's only when the law actually goes in, and that's when this kind of stuff gets used, right? And it's just possible there could be given assurances that it would not actually result in risk to the system, but it would really just take the net value of the position. On the flip side, most likely it will probably just confiscate the whole thing and end up with an empty CDP. And in that case, it's it's basically a matter of trying to model the risk of that and ultimately hedge it.
Okay. I want to go back to another point, Rune, that you mentioned earlier, but I'm going to ask Joao. So we saw, let's say you have $1 million in USD tokenized, you have 1 million USDC issued out. Rune was talking about interest rates, right? If you have $1 million in your bank account, you get paid interest rate on that, yeah? But do you guys have plans to expand to other currencies like Euro or Swiss franc in the near future?
Absolutely. We think that there's a tremendous opportunity for continuing to build on top of this infrastructure, and there are many ways to scale it. One of the ways to scale it is scale into other, what we call other flavors of fiat tokens. So absolutely, fiat tokens that are backed by euros, by pounds, by Japanese yen, whatever. Yeah.
In the example of the Swiss franc, I'm not sure if you know because you don't live here, but in Switzerland we had negative interest rates for the, I don't know how long already. I think right now it's negative 75 bips. How would you handle that? Would you, I mean, if you would not pass it on to the end user, Circle would make a loss, or the issuer would make a loss. Have you guys already talked about this, or it's not a topic yet?
We discussed it, yeah, absolutely. And by the way, you know, this is an active topic of conversation. It's also an area that regulation impacts a little bit. So regulators want to understand how a company or a solution like ours and others, how they make use of the what we call the reserve balances, right? And obviously you're very, very limited in what you can do with the reserves, and that's a great thing, because obviously we don't want to be investing the reserves in property or something that is very risky. You basically have to have that buy wall, right? But there are very, very safe investments and products that the financial industry offers that would allow you to gain, you know, a small but still interesting rate of return on that capital. But that varies from currency to currency or jurisdiction to jurisdiction, right? The interesting thing, though, is that is a problem that can probably be mostly solved also with technology, because the smart contract, you can introduce things like, you know, inflation or deflation on the smart contract. So by, for example, introducing some sort of fee, right, on transfers, that's not something that we have on the code and anybody can check right now. But again, through software, you could easily deploy an update to the smart contract that all of a sudden introduces some sort of inflationary or deflationary policy, and you can sort of model that through that then.
Okay.
I think it's solvable through technology.
Yeah, I mean, even your approach us now with inflation, deflation sounds like a good approach. I think we're slowly running out of time. I do want to give the audience a chance to ask questions. Before that, my last question to both of you, very quickly, very quick answer. I always thought one of the most killer apps in crypto is just payments, especially cross-border. You know, the stablecoins that you guys have take away the price volatility a bit, so it makes it even more feasible. But in your own view, what's the next step, or what's missing for more widespread adoption of stablecoins? I mean, we have, how many million do we have in DAI? 77?
Yes. Yeah. Maybe
and how much do you have in USDC?
I think 275, 280, something like that.
So 360 in total. 360 million is a drop in the ocean? Yeah, drop in the ocean.
It is, yeah.
Yeah, so, you know, what do you think, what does it take until the common man can use DAI and USDC to just buy your books and stuff?
I can start. I'll try to be quick. I think we're still far. I think for payments we're still probably far away. But we were just discussing. I think 2018 was very exciting. If you can say that anything was exciting in the crypto industry in 2018, I think it was the stablecoin space, right? Because I think the industry realized that this is actually a foundational piece of infrastructure for a lot of these use cases that we have been talking for years now, to potentially have another chance at gaining, you know, mass market adoption, and payments being one of those. Although I think we're probably a little bit removed from payments because from a scalability point of view, I think layer 2 solutions and there's a lot of very smart people working on those, but they're still not concrete enough that we can start rolling out infrastructure on top of it. And for payments, if you really want to compete with, you know, the Visa and the MasterCard rails of the world, you need tremendous amount of scale that we just don't have yet. I mean, you know, USDC runs on top of Ethereum, and you could argue that you know, it wouldn't scale to like even a slightly successful payment mechanism. But I think we're getting there. I think at least now having, you know, this portfolio of solutions that developers all around the world now can reconceive how they're going to build their services on top of crypto and say, yeah, I have to have a stablecoin as part of my offering, because that's how, you know, I'm going to onboard and offboard people from fiat seamlessly. Perhaps they don't even know that they're using a stable coin, right? And maybe you can start from use cases around the edge of payments, something like settlement, FX, remittances, those use cases, and I think eventually we'll get to payments then. So we're very excited about this being the shoots for hopefully in a couple of years' time, us really seeing solutions that seamlessly, perhaps even without the mainstream consumer knowing, they're actually using crypto in the backend for payments.
All right, Rune, you got the last word.
Yeah, I mean, I think so. What we are more excited about in terms of where we'll see the growth, and I guess that's natural based on how our platform works, right? Is on the lending side and how we want to, like how Maker is going to facilitate allocating capital out to all sorts of different systems and financial instruments. But I think where it really comes together is when you think about the synergy and sort of the fundamental value of blockchain, right? Because so in addition to 2018 being the year of the stablecoin, what we're also seeing is a lot of security tokens, right? And seeing just a lot of tokenization and all this stuff. And I think it's really going to be, once all of this stuff really starts fitting together into a more coherent ecosystem, that's when you'll just, the bigger it gets, the greater the argument for why everyone else should join the party will become, right? And it'll be like this big snowball that just keeps rolling and gets bigger and bigger. And when we get to the start of that point, which is what we in Maker call critical mass, right? It's still hard to say because, yeah, I mean, it is really kind of like a drop in the ocean at this point, and it's hard to know what the big break is where the real world suddenly takes us seriously, right? But I definitely think that it's not. I mean, the momentum is there that we can get to that point. I'm pretty sure of that.
I think everyone in this room agrees with that, actually. Well, on that note, I want to thank both of you. Thank you very much. It was very interesting to talk to you. Give it up for Rune and Joao. I think we have time for 2 more questions. Yeah? Okay. Edward over here. You were the first one.
Hey there, Edward from Web3 Foundation. This is for Rune. The interesting graph that we had on CoinMarketCap, it looks like there's a slight bias to the top side. And I'm wondering, is this a meaningful bias, or are we fooled by randomness? Okay, yeah. Or am I fooled by randomness even?
So this is where I talk badly about CoinMarketCap's data. No, so I mean, the best thing I can tell you is CoinMarketCap is good for kind of like a superficial overview of what's going on, but don't take the data too seriously. Basically, wash trading. I think we've all heard about what's going on with that. I mean, once you actually look into the scale of wash trading in crypto markets, you'll be surprised because it's pretty ridiculous. And what the numbers say on CoinMarketCap is not what's actually happening. So yeah, so basically when you look at a graph that's taken from CoinMarketCap and it's not done proper signal processing on it, basically you can't really conclude much from it. And but it's a funny point though that you're saying that you're seeing an upside bias. Because we actually recently, like I was saying, we're actually doing these stability fee adjustments, right, to kind of try to stabilize the DAI price. And we actually been running into this, so what sort of the data analysis has been showing is that the price has actually been weak over the last couple of weeks, and we'd have to actually increase the interest rates to deal with that. And then what happens is a lot of people are like, no, if I look on CoinMarketCap, it's too high. And you actually are in that situation where you have to be like, well, okay, time to talk that about data, right? But ultimately, yeah, don't trust CoinMarketCap.
All right. Okay, I think Gavin is getting ready right now, so we're going to end it here. Thanks again, Rune and Joao.